Well, barriers to affordable homeownership have long been a problem, especially for first-time buyers and communities of color. Rising rates and talks of recession certainly not helping the cause. One of America's biggest banks is looking to take some action. Bank of America announced it is testing zero down payment mortgages with no closing costs in predominantly Black and Latino communities. But how big are the risks? To break it all down, let's bring in Indiana University Kelley School of Business Professor Jun Zhu. Professor, good to have you on today. Let's sort of first define what exactly a zero down mortgage is. What are the terms that come with that?
Well, thank you so much for having me. It's a pleasure to be here. Well, I think this is a good question. Actually, U.S. has experimented with a lot of the ways of providing, down payment assistance to cash-constrained first-time home buyers. And the program like this would be one of those down payment assistance programs. The main reason for doing that is try to provide support to, for the homeowners to fill the gap between available savings and also the upfront cash needed for a down payment.
Yeah, no question. When you think about just that cash that's needed for the down payment, that creates a huge barrier. But how significant have those barriers been, especially in communities of color?
Well, actually, the down payment assistance programs will be very helpful for home buyers, especially for the first-time home buyers with, wealth and saving constraints, because those constraints prevent households from buying their homes. So a program like this will be helpful for non-white households, or, we can define those as minorities, because compared to the white households, minorities sometimes do not have sufficient liquid resources to compete for a home. Moreover, we know that minority households generally have lower income compared to the white households, also together with fewer savings. So if we have a program with no down payment, no closing costs, it will help minority family to fill the gap between available savings and also the upfront cash needed for the down payment and closing cost on the house.
You mentioned that divide that we have seen between those who can't afford homes and minority families. How much of that has widened, especially over the last few years when you think about this huge wave we saw into home buying? Now that we're looking at rates going up, affordability coming down as well, how much do you anticipate that will widen?
Well, I think it's a very good question, and the answer to the question is not simple, and I don't want to speculate here. But I feel that the same I want to emphasize is that homeownership is definitely one of the best ways for American family to accumulate wealth, because as the borrower pay down their mortgage, they can earn wealth through home equity. And if we take a look at the net worth of homeowners, about 47% of the net worth was coming from home equity. And for minorities, the percentage number is actually higher. For example, home equity makes about 60% of the total net worth for Black homeowners. So I think it's very important to get the households into the home buying market.
And while we're talking about Bank of America today, obviously there's other banks like JP Morgan that have offered similar mortgages. What are the risks on the other end? I have to admit, when I first read about this, I thought this may be good to get into a home, but what are the repercussions that are waiting?
Well, actually, think about when the home buyers actually was entering the mortgage market, they still need to pay down the monthly payment. And if we think about this case, all else equal, we are talking about a low down payment loan. This loan would perform worse if all else equal. That is, if we take a look at loans' other characteristics, they are all similar, then a higher LTV loan would default at a higher probability. However, we know that there's so many dimensions. We have credit score, for example, as one dimension, and there's multiple dimensions influencing the default risk. So I think, the borrower's down payment is just one indicator of the default risk. So if we can monitor the risk very carefully, that would be good.
Okay, we'll be watching. Indiana University Kelley School of Business Professor Jun Zhu, appreciate you joining us today.